Okay. Good evening. Okay. So we have written, listen. National anti-profiteering. Yes. Okay. Let's start with positives and negatives of GST. Okay. So first let me draw the box and you will tell me some points. Positives and negatives of GST. Okay. Huh. So one is it is simple and easy to administer. Okay. So simple and easy to administer. Okay. Huh. And second important aspect is it increases tax compliance. Yeah, tax increases tax compliance. Okay, comma, reduces tax inefficiency. Reduces tax inefficiency. Okay, and हाँ ये सब इसमें आ जाएगा. Okay, widens tax base. Very good. Widens tax base. Okay. Then it reduces leakages in the system, reduces leakages, thereby increasing efficiency, same aspect, thereby increasing what? Efficiency. What else? Okay, so GST helps in formalization of Indian economy. Okay. GST helps in creating a national market. One nation, one tax. One nation, one tax. You're creating a national market for doing business. One nation, one tax. No, national market for doing business. So we are saying one nation, one tax. If cascading effect is going to reduce, okay, for the producer also, Ratan Tata is producing some goods, cascading effect is decreasing, means cost of production for Ratan Tata will decrease, then the final product will also be cheaper. That means GST has a positive impact on reducing the cost push inflation. GST has a positive impact on reducing the cost push inflation, demand pull, cost push. Is that okay? So it helps in reducing the cost push inflation. So it helps in reduce. According to statistics, all those countries which have launched GST were able to increase economic growth in the long term. Remember? Okay, so all those countries which were able to launch GST were able to increase economic growth in the long term. GDP growth, they were able to increase in the long term. Okay. GST promotes a principle of tax democracy. I use this word, tax democracy. Remember, poor people's necessities are into 0% or 5% bracket, and luxuries and sin goods in 28% bracket. This is basically a concept called as what? Tax democracy. Talked about it. Okay. Any other positive? IGST, I'll write it in the negative. कैसे पॉजिटिव हो सकता है? Okay, fine. I'll positive ठीक है, but if I write it in positive, I'll not have points for writing negatives then. Okay, so take it that way. See, there will be positive and negative. IGST is a complicated system. According to economists, IGST looks very complicated, complex. Is that okay? So think other than IGST. See, GST actually, GST has helped in increasing logistics efficiency. Increasing logistics efficiency. Okay. So under GST mechanism, there is also something called as the e-way bills. Okay. So what are these e-way bills? See, one of the biggest problem in India is not about producing the product, but when you take the product into the market, because of logistics inefficiency, the product becomes costly. Okay, why? Because one aspect is most of the transportation is road transport, around 58 to 60%. That means you're crossing borders, entry taxes, tax inefficiencies, etc. Product starts becoming costly. Okay. And for seamless movement of goods, government has come up with a concept called as e-way bills, where online portal, this E is online, right? Online portal, you're going to apply for a e-way bill. Okay, so whether it is for interstate trade or for interstate. So when you are moving, okay, so you can apply for what e-way bills, which will help you to easily transit, without much of hassles. So this will definitely help in something like logistics efficiency. Another important aspect is, don't you think GST will promote specialization or reduce specialization? See, if cascading effect is reduced, suppose Ratan Tata is there, Ratan Tata wants to manufacture some product, cars or something. Now, if there is cascading effect and if the lead times are more, lead time is something like the time period between the producer is ordering a product and he is receiving it. There's a gap. Okay. Supply chain efficiency will be there when there is less lead time. So by the time I order the product, I should get it within 2 days or 3 days or 4 days, whatever it is. But if the systems are inefficient, transportation, etc., then lead times will be higher. Under such circumstances, probably Ratan Tata may decide, cascading effect is also there. So Ratan Tata may decide for vertical integration. Vertical integration means, why should I buy tires from MRF? Let me manufacture tires. Let the car design be given by TCS. Okay, let TCS design and give the design. So that means the whole supply chain, whether the suppliers, Ratan Tata also can have his own retail shops. The complete supply chain will be handled by Tatas only. So Tatas have the capacity for vertical integration. Bigger companies, rich companies with deep pockets can do. Reliance can also think of doing vertical integration. Why should I buy something from MRF? Okay. Or why should I buy steel from outside? Let Tata Steel only supply steel for my cars. Okay. So when cascading effect is less, then companies may think of subcontracting. Companies may give away, or companies can go ahead with subcontracting. What is subcontracting? Ratan Tata or the Tata Motors will not do everything by itself. So Tata Motors may give give few things to MRF or maybe some other company, etc. So this is basically helps in specialization. So more specialists will come into picture, and specialization will always improve efficiency. Specialization will always improve efficiency. Don't ask me, IAS is a generalist. No, don't you think he's efficient? IAS is generalist, but he's efficient in the sense because the administration is completely different. Okay, manufacturing is completely different. So when we talk about specialization here with respect to manufacturing, more specialists, more value addition, automatically the quality is going to increase or improve. I think you're getting my point, right? Okay, so now suppose there is a company like BHEL or Tata Motors or BHEL. Now they may decide to go ahead with subcontracting. There are ancillaries outside, small engineering firms, which will take the contracts from the bigger company, and they start producing the products and they will supply it to Tata Motors or BHEL. Now this is basically the logic of subcontracting. Okay, and this will also help in specialization. This will also help in something like increase in direct tax revenues. One of the interviews, they've asked, do you think GST may have a positive impact on even direct taxes? So GST is an indirect tax, but if GST can help specialization, and because of GSTs, if there is more of ancillaries developing, which is called as ancillarization, there will be more jobs that can be created in these ancillaries. So more jobs in the sense, more direct tax collections, more income tax collections indirectly. So that means GST can bring in efficiency through specialization, and GST can also lead to ancillarization. Ancillaries can develop in and around a bigger company, and that will also help in increased tax collections because of job creation. So this is also one more benefit of what? GST. Are able to get this? Okay, so along with logistics efficiency, GST can also help in ancillarization and creation of jobs, indirect effect. So it can also help in ancillarization. Okay, so setting up of more ancillaries or small companies, because GST can help in bringing in specialization. Is that okay? वो जो एंटी प्रॉफिटियरिंग वाला, आई राइट इट इन द नेगेटिव. ठीक है. इनपुट टैक्स क्रेडिट तो वैट में भी है. See, the purpose of GST and VAT system, see, so what he's saying is ITC is what? Input tax credit. So how did we calculate VAT liability? VAT liability is what? VAT on output minus VAT on input. This is what we did. Okay, output was tax paid on 4 lakh furniture minus tax paid on wood, 40,000 wood was 4,000. Okay, so we landed up with tax liability of how much? 36,000. GST also runs on the same concept now. So GST is also running on the same concept. So here, suppose there is this supply chain which is moving. Supply chain. Okay. In this supply chain, the same concept applies. That means GST is also something like the VAT system, GST on output minus GST on input. Same logic. But here when I say GST, excise is included, service tax is included. Okay. So all the taxes are included. Separately you're not levying. Are you able to get my point? So GST also runs on the concept of VAT only. At each level, VAT is applied, isn't it? Value addition concept. Okay, so GST also runs on the similar principle. So that means ultimately you are paying tax only on the value addition. So therefore, because of that, cascading effect is reducing. So more specialists can enter into the system. You will bring in somebody else for something. You will bring in somebody else for something. This is specialization. Are you able to get this? No. Okay, so I'll allow more manufacturers to enter into the system for some specific activity. Okay, so this will help in specialization, etc. And also value addition is going to increase. Specialization will always increase value addition. Value. You're adding more value to the product. Value, furniture, wood. Okay. So is this clear till here? So I've also written something like logistics efficiency. Sorry. Any other benefits of GST? Okay. So I'll write. Okay. So I will write one point here. GST promotes, one is cooperative federalism. Heard of this word? Cooperative federalism. Okay. So for example, Arunachal is here, Maharashtra is here. Okay. So since it's a destination based tax was going to Arunachal, and slowly you are saying yes, Arunachal will also improve. So one is cooperative. Another aspect is GST will also promote competitive federalism. GST will also bring in competitive federalism. Competitive, why competitive is one nation, one tax. That means almost tax rates are same. If I want a company to come up and set up its uh, a company to set up its organization or its factory in my state or in a particular state, that state has to be efficient. Other than the taxing also, single window clearance mechanisms, easy approvals, etc. Efficiency should also be high. Then only that particular company will probably think of setting up its factory in that particular state. So what is this? States will start competing among themselves for better business fundamentals. That means you will come up with following better business fundamentals so that the factory will be set up in your particular state. Are you able to get this? This is what I'm using a word called as your competitive federalism. One nation, one tax. So that means tax benefits are not much. So tax benefits are almost the same. Then automatically the states have to become more efficient with respect to doing business. So doing business index of states should improve if the factory has to be set up in that particular state. So GST obviously will also improve the doing business aspect. So doing business index of states will increase. Doing business will become easy because of GST. Is that okay? So that is also one more aspect. And then another important, any other benefit of GST? It increases tax compliance or transparency. Okay, somebody has mentioned transparency in the taxing system. I'm writing it. Okay, easy to administer, transparency has increased, tax compliance, tax inefficiency has reduced, and it has widened the tax base. It also helps in formalization of Indian economy. Why formalization? Suppose in this example, let's say this is Ratan Tata, and let's say Ratan Tata is buying some goods from some X company, and this X company is not under GST. It is not under GST. Based on the reverse charge mechanism, now if this supply chain should not get disrupted, there is a concept of reverse charge. Means the responsibility of filing the tax and paying the tax in this transaction falls on the buyer or Ratan Tata. So next time Ratan Tata may think, why should I do business with somebody who's not in GST? So automatically this small player will also opt for GST. He will also decide, let me take GST. So more smaller companies going ahead with taking GST means it is automatically leading to formalization of Indian economy. Those who were not in the tax ambit, those who were earlier did not take VAT, etc. Now they started taking GST numbers. This indicates what formalization. They are coming under the tax ambit of the government. So that is what is formalization. Is that okay? So that is also one more. National market reduces inflation. And for the business houses, more tax transparency means the business houses can easily take decisions. So business decision making will become easy. So because tax, and it will also help in, if your taxing system is more efficient, then you will have more FDIs and FIs moving into the country. So better GST or better tax means not only growth, but also you will have foreign investments moving into the country at a faster pace. They will be interested in doing business in India because your taxing system is more efficient. Is that okay? Yes. Okay. Now, in spite of all this, there are some challenges still there. So challenges or there is something like a scope for there is some scope for improvement also. Okay, so which are the areas where improvement is still needed? Okay, so can you give me some points where improvement do you think? See, one aspect is, GST compensation cess is a good idea. I'll make you write anyhow after 2 minutes. So GST compensation cess, 2017, they have come up with GST Compensation Act. Okay, so this GST Compensation Act's logic is what? From July 1st, 2017, GST is launched till July 1st, 2022. July 1st, 2022. Okay, so government said we will compensate the bigger states. Why bigger states? Because they were losing revenue. Whichever state is losing revenue, that state will be compensated. And obviously the bigger manufacturing states, Haryana, Maharashtra, Gujarat, Tamil Nadu, these states were losing out revenue because they were producing products. So these states will be compensated. But during COVID pandemic, there was some trouble with respect to the proceeds not being given to the states. So every 2 months, the proceeds have to be given to the states. Every 2 months, the compensation cess proceeds have to be given to the states. So there was a delay, whatever may be the reason. It can be COVID also. COVID is there for states also. COVID is not just for the center. Okay, there was a delay with respect to payments, so you're losing the trust of the state. So this GST compensation cess now has been extended till 2025-26. Earlier it was only till 2022. Now they have extended. So how are they going to collect this cess? This extra cess is, what is the meaning of cess? Cess is a tax for a specific purpose. So here the purpose is you're collecting that money and mainly trying to compensate states which have lost revenue because of GST. Is that clear? Understood? Okay, so they said we will levy tax on sin goods like pan masala, tobacco, and also automobiles, etc. We will levy. Okay, automobiles, pan masala, tobacco, etc. We will levy additional charge. Other than the regular rate, additional cess will also be levied. But that money which they collect has to be given to the states. This is the logic of compensation. But delivery was not okay. That means there can be some efficiency here. Okay. Similarly, IGST system looks complex. IGST system looks complicated. Okay. Center is levying, collecting, okay, and keeping it aside, again giving it to the states. What is the purpose? State can only collect, no. That importer state can only levy and take it, no. So why are you having a IGST system in place where center is levying, collect the revenue, keep it outside consolidated fund, give it to the state? It looks complicated. Okay, you levy CGST, you take. That state will levy SGST, it will take. Yes or no? Okay, so it looks complicated. So economists were saying your IGST system is not so okay. So it looks complex. Another important challenge is initially, this is now it's okay. Initially, to achieve revenue neutrality. Did I use this word? Okay, yesterday I've used this word. To achieve revenue neutrality. Initially the tax rates were high. Initially, they landed up levying higher tax rates to ensure revenue neutrality. Initially, they started levying, I've used the word, I'm not writing any word which we have not discussed. I think all those words have come up in our discussion, isn't it? So, initially the tax rates were on a higher side to ensure revenue neutrality. To ensure revenue neutrality, initially the tax rates were high. Slowly, step by step, they started reducing the tax rates. I hope it is clear. Okay. And still there is confusion. Still there is confusion over control. Confusion over control of certain goods between center and state. There is confusion of control over goods, okay, between center and state. No, they are struggling. Okay. And also, even now there are exemptions still there. So always it is better that you keep exemptions as minimum as possible so that the base will be wider. So there are exemptions even now. For example, petrol, 5 petroleum products, yes, alcohol or electricity, customs, basic customs center is handling. That means what? Exemptions still prevail under GST. There are still exemptions still prevail under GST. Or when we talk about road taxes, there are a lot of complications, etc. So like this, exemptions still prevail under GST. And these exemptions, if you keep it to the minimum, then the base will be wider. So if the base is wider with lower rates also, the revenues can increase. Revenues can increase. Is this clear, everybody? Okay. Another important aspect is, though GST Council on the face of it, of course it's a polity point, GST Council on the face of it looks, it is promoting cooperative federalism. On the face of it, yes, true. But again, but states are given 2/3 weightage. center is given 1/3 weightage. Okay, centers vote 1/3, state 2/3. But at the same time, if you want to take a decision, you need a weightage of 3/4. So that means center's role is yet to play. There is still center's role. Center plays a critical role in decision making when it comes to GST Council as well. So it doesn't look truly competitive, truly cooperative federalism. Center's role looks to be instrumental in taking decisions because you need 3/4 weightage. So probably I'll not write it here, but that's also a point where you can say, though on the face of it, GST Council definitely yes. So here on positive, I can write GST Council promotes cooperative federalism. Positive. Cooperative federalism, and states have been given higher weightage. Fantastic. Is this clear? Understood? Yes. Here I will write, I'll not write profiteering, I write National Anti-Profiteering Authority can be seen as a backdoor entry of, it can be seen as a backdoor entry of license Raj. Backdoor entry of license Raj. What happened to input tax? Input tax is okay. So, National Anti-Profiteering Authority can be seen as backdoor entry of license Raj. Okay. If I want to extend it or make it a little more complex, GST composition scheme. Composition scheme. So, companies under composition are not, though on the face of it, you're promoting MSME. Good. Okay. But at the same time, they're not eligible for input tax credit. And the composition scheme, the MSMEs are not eligible for ITC, input tax credit. So that means on one side, yes, it is good because it is enhancing tax compliance. They will file taxes at rates lower than the regular rate. Regular rate is 0, 5, 12, 18. And for the MSME under composition, the rates are lower. So that is good. But at the same time, they are not eligible for input tax credit. So if I want to write that also, I can write, but I don't want to put it here anyhow. Is that clear? Yes. Confusion between because of multiple slabs and also control. So center controls few, state also controls. So always there is this confusion and discussion always in the council. Uncertain. GST Council. So no. The council is not so. It's like GST Council is ensuring stability. Not. There's no example like creating conflict between two states or something till now. So we'll take council from a positive perspective only, cooperative federalism. But in the voting procedure, center has a role to play. That's all for GST Council. No. Voting center's vote is required. 3/4 weightage you will not get without center. 2/3 is the weight of state. But 2/3 is the weight of state. But for passing, you need 3/4. Means center is needed. Okay, indirectly center is holding some control. Is that okay? Today it's your second class, right? Yeah, you're looking very fresh. Clear till there? Yes. Seriously, you're looking fresh. Positives. And I think I need not expand. You need dictation or is it sufficient? We'll add on. Did I write tax democracy? Yeah. So anything left out, I would have missed something. So one point which I've missed in the positive. You have completed this? Okay, write down fast. Write down first point. Write down. Positives of GST. Those who have not written or those who are not satisfied with what you have written. Okay, so write down positives of GST. Write fast. Write down simple and easy to administer. Right. Simple and easy to administer. as multiple indirect taxes, as multiple indirect taxes, multiple indirect taxes at the central and state level, at the central and state level, are replaced by a simple tax system. Simple tax system. Moreover, continue. Moreover, backed by, backed by end-to-end IT system, end-to-end IT, information technology, backed by end-to-end IT system, it would be easy to administer. It would be easy to administer. Okay, next point. Relief in overall tax burden for the consumer. Relief in overall tax burden for the consumer. Okay, next point. Simple and transparent tax. Simple and transparent tax that will lower inflation in the long run. That will lower inflation in the long run. Okay, next point. GST helps in creation of national market. GST helps in creation of national market. In brackets, write one nation, one tax. One nation, one tax. Is that okay? Next point. Tax democracy. Tax democracy. That is, luxury items would be taxed more. Luxury items would be taxed more. And the basic necessities will be exempted. And the basic necessities will be exempted. Is that okay? Next point. Ease of doing business. Ease of doing business due to better tax compliance. Ease of doing business due to better tax compliance. Is that okay? Next point. Removal of cascading effect. Removal of cascading effect. Thereby increasing tax efficiency. Thereby increasing tax efficiency. Next point. Uniform tax rates. Uniform tax rates will help in better decision making. Will help in better decision making and increased investment by corporates. And increased investment by corporates. Next point. It increases specialization and ancillarization. It increases specialization and ancillarization. And ancillarization and also helps in and also helps in, is that okay? And also helps in boosting foreign investment, also helps in boosting foreign investment due to increased transparency, due to increased transparency. Okay. Next point. GST helps in increasing economic growth in the long run. GST helps in increasing economic growth in the long run. Okay, next point. GST increases logistics efficiency. GST increases logistics efficiency. Okay. Last point there. GST system has led to increase in new tax registrants. Increase in new tax registrants. New tax registrants. That is formalization. That is formalization of Indian economy. Formalization of Indian economy. Okay. Next, put the heading negatives of GST. There are exemptions under GST. There are exemptions, right now. There are exemptions under GST. And in the initial stages, there was very high revenue neutral rates. There was very high revenue neutral rates. Very high revenue neutral rates. Next point. Anti-profiteering clause. Anti-profiteering clause was seen as a backdoor entry. Was seen as a backdoor entry of license Raj. Was seen as a backdoor entry of license Raj. Next point. Confusion regarding control over taxation. Confusion regarding control over taxation. Is that okay? Next point. Issues related to compensation to developed states. Issues related to compensation to developed states. Okay, sufficient. Huh? Next, you will put the heading GST compensation cess. GST compensation cess. Okay, GST compensation cess, write down. Due to consumption-based GST system, due to consumption-based GST system, due to consumption-based GST system, manufacturing states like Gujarat, Haryana, Karnataka, Maharashtra, and Tamil Nadu feared revenue losses. Feared revenue losses. And therefore compensation cess was introduced. And therefore compensation cess was introduced. Compensation cess was introduced to compensate for possible revenue losses. Possible revenue losses suffered by such manufacturing states. Suffered by such manufacturing states. Continue. Under existing rules, GST compensation cess would be levied only for the first 5 years. Only for the first 5 years of the GST regime. Only for the first 5 years of the GST regime. Okay, so that should be July 1st, 2017 to 2022. Is that okay? But now it has been extended. Recently, they have taken a decision that this compensation cess is going to be extended. Okay, so till 2025-26. Is that okay? Okay. So currently extended to 2025-26. Currently extended to 2025-26. Continue writing. Full stop and continue. The compensation cess payable to states. The compensation cess payable to states is calculated based on the methodology specified in the GST Compensation to State Act. In the GST Compensation to State Act 2017. There's a separate act, GST Compensation to State Act 2017. So there was a CGST Act separately, SGST Act, and also GST Compensation to State Act 2017. Is that okay? Yes. Continue writing. The compensation fund so collected is released to states every 2 months. Continue. Any unused money from compensation fund, from the compensation fund, at the end of the transition period, shall be distributed between center and state, as per any applicable formula. Continue writing. Compensation cess is levied on sin or luxury goods sin or sin, sin, sin or luxury goods as mentioned in the GST Compensation to State Act, as mentioned in the GST Compensation to State Act 2017. GST Compensation to State Act 2017. Is that okay? And includes items such as pan masala, tobacco, automobiles, etc. Pan masala, tobacco, automobile. This is okay. Done. That is about positive and negative. Then and composition. Now put a small side heading. E-way bills. E-way bills. E-way bills. Write down. It is electronic way bill system. Electronic way bill system. Electronic way bill system offers technological framework technological framework to track intrastate as well as interstate movement of goods of value exceeding rupees 50,000 for sales beyond 10 kilometers in the GST regime. Okay, full stop and continue. When an e-way bill is generated, a unique e-way bill number is allocated. A unique e-way bill number is allocated. Okay, fine. FRBM is important for exam. Is it okay? No, okay. See, when you're writing, write with a smiling face. You are writing as if like, you're writing for yourself only. Tomorrow, after 6 months, when you're reading GST, whatever is discussed in the class, I think 90%, 80% you'll not remember, unless and until very focused, and which I don't think so. Okay, so which I don't think so. So probably another 3 months, 30% will get deleted. Another 3 months, another 15, it gets eliminated. And by the end, before the exam, everything looks fresh. Everything is fresh now. Now GST. Again, you'll start. So if you read, probably you will connect the class, and then, so you're writing as if like, you only said you want dictation. Huh? हाँ पढ़े थे कभी. The thing is, during exam, only GST question solving should be there. So then you'll come to know a few things which are not discussed. By solving questions, we get to know new things. So that should be added. That's what you have to do. Okay. So what was the last thing? 10 kilometers. Write down, write down. When an e-way bill is generated, a unique e-way bill number is allocated. This is what we were talking. Okay, allocated and is available to supplier, comma recipient and transporter. It was mainly launched to facilitate faster movement of goods, and also improve logistics efficiency. Okay. A fine of rupees 10,000 can be levied. A fine of rupees 10,000 can be levied if a consignment moves without generating valid e-way bill. Okay. In some situations, goods and vehicles transporting can be seized. ठीक है? So we'll try to understand few direct taxes, and few are not there today. Okay, there are some direct taxes which are not in existence as well. Okay, and most of the direct tax acts, not all, most of the direct tax acts are handled by Income Tax Act. Of course, there is separate Wealth Tax Act. Act I'm talking about, not the tax. Of course, this tax is not there now. Okay, this was a direct tax. This was also a direct tax. Okay, earlier there was taxes like estate duties. Okay, so wealth tax is also not there now. Okay, so different acts are there. Okay, there was a gift tax act. Okay, now first of all, direct taxes are those taxes where the incidence and impact are at the same point. You know this. Incidence and impact are at the same point. Okay, and direct taxes, most of the direct taxes, like income tax especially, are seen to be bring in equity because they are progressive in nature. Okay, so progressive in nature, and we have written what is progressive, regressive, and proportional. Okay. Now, if government has to increase tax revenues generally, and it has decided to increase tax rates, it is better to increase the tax rates of direct taxes rather than indirect taxes, because indirect taxes seem to be regressive in nature. Okay. Now, most important direct taxes, one is income tax. And this tax actually, we have seen the calculation also, the income tax slabs. Yes or no? 0 to 3 lakhs, 3 to 6. Okay, so, and then we have understood tax exemption, then tax rebate, all that is related to income tax. What is the maximum surcharge presently levied? How much percent? Maximum surcharge presently according to the new budget is 25%. This is what I mentioned. And then I said how the tax liability is calculated, and then surcharge, then cess. Okay. And these income taxes are seen to be progressive, but they turn out to become digressive after a certain period of time. Remember? Yes. Then one of the most high revenue giving taxes is corporate tax. Actually, corporate tax is nothing but income tax only. Okay. Corporate tax is nothing but income tax of corporates. Okay. It is nothing but income tax of corporates. But the thing is, since the revenues are high, corporate tax collections, earlier before GST, the central government used to get maximum revenues from this tax. Now it is GST followed by corporate taxes, followed by income tax. GST followed by corporate tax, followed by income tax with respect to collections. Okay, that means corporate tax is a high revenue giving tax, and though there is no difference, it is almost the same. It is like the income tax, but income tax of corporates. So therefore, since the revenue is high, they started putting it in a separate head. They started putting it on they did not include it in the income tax, and they were placing it in a separate head or a separate criteria. Okay, so called corporate tax. But corporate taxes are levied on basically the profits, the income or the profit which the companies are earning. Now, companies used to use different methods to reduce their profits. So, companies have their own ways to reduce their profits. They can use something like deductions. Companies can use deductions. So, these deductions are legal deductions given by the government itself. So, they will try to use the deductions and exemptions possible. Okay. And they will also have, they can also do some donations, etc. There are some donations to some NGOs, etc. Okay, so which will be given some tax exemption. Okay, they will show something like the depreciation expenditure. Depreciation expenditure. Depreciation expenditure means for maintenance of assets. There is an asset that has to be maintained. So you are to maintain that asset, you are spending some money. Some companies have higher depreciation. For example, when we talk about power companies, power companies have higher depreciation. So therefore, they ask for higher tax exemptions. So companies generally, though their books clearly show book profits, what is visible in the books. Let's say 100 crore is the book profit. Now that company through exemptions, it will show exemptions are 50 crore. Okay. And then that company says another 40 crore is the depreciation expenditure. Depreciation expenditure. Depreciation expenditure. Another 10 crore. Of course, dividends will not come here. Dividend will not come here. Another 10 crore. Let's say the company is talking about some donations, etc. Now companies start claiming themselves. So after all these, the companies say, we are basically a zero tax company. No profits only. No profits only. What about? No, no. No loans here. Here I'm talking about a company and profits. There's no question of loan here. Loan is not a deduction. It can be something like they can give some fringe benefits. There is something like fringe benefits to employees. No loans here. Fringe benefits. Employer can give some additional benefits to employees. So, for example, other than salaries, he can also give conveyance, telephone bill, newspaper bill. Okay, so all these travel expenses. So these are what fringe benefits other than the salaries. So one is the salaries, but other is fringe benefits. So like this, companies use several deduction methods to claim themselves as zero tax companies. Zero tax companies. So by doing that, so they will try to show that the corporate tax collection, that is, they will show that the profits they have is almost less than 30% of what they have collected earlier. 30% of what they collected earlier. Now, 30% of what they have collected earlier, or they can also claim themselves as, in this example, basically the company comes out and says we are a zero tax company because we are not left with any profits after the deduction. So 50 crores we have spent on exemptions, deductions which legally you gave. 40 crores we have spent on depreciation. That means for maintaining the assets out of the total 100 crore. Okay, so we have to maintain the machines, maintain the lathe machines or turbines, whatever it is. We have spent some 40 crores from our pocket. Then again another 10 crore of donation, etc. So ultimately we are not left with any profit, or they will show they are left with minimum profit. Either it can be in zero profit, or they can show minimum profit. Now this is how companies start manipulating using the tax loopholes or exemptions or deductions, etc. And these companies claim themselves to be zero tax companies. Okay, so if you see the books of the company, you will find 100 crores in the book profit. But after the deductions, etc., you will find the companies are claiming themselves as a zero tax companies. So here what has to be done, last 3 years data has to be taken into consideration and check how the profits were there 3 years back and what is the situation today. If the companies are wantedly reducing their profits to such an extent that it is going up to 30% below the profits what they have earned. So the tax official will be easily be able to check what is happening here, based on which there is a tax which they come up with called as a direct tax called as MAT, minimum alternate tax. MAT earlier came up in 1988, then removed and again reintroduced in 1996. Okay, so minimum alternate tax. What is the meaning of minimum alternate tax? It is a minimum guaranteed tax which the companies have to pay on their book profits. So that means this MAT was introduced earlier. The tax rate of MAT was 18.5% of book profits, whatever is visible in this box. Now it has been reduced to 15% of book profits. 15% of book profits. So here, one is, if there is corporate tax, if the company is paying corporate tax, then you need not pay MAT, obviously. Okay, so since companies are not paying corporate tax, by using the deductions and exemptions visible, deductions are there, exemptions are there, and they are showing that they are zero tax companies and therefore they are not paying corporate tax. But seeing the data, companies levy, the government started levying something like the minimum alternate tax. What is the meaning of minimum alternate tax? It is a minimum guaranteed tax which the company has to pay if they are claiming themselves to be a zero tax company. Claiming themselves to a zero tax company, you pay a fixed amount of tax at a rate of 15% of your book profits. Pay a minimum amount of tax at a rate of 15% of your book profits. 15% of your book profit. So 15 crore. So if you are paying this 15 crore, obviously you are not paying corporate tax. Either you will pay corporate tax or either you will pay MAT. Are you able to get this? And MAT is not levied on those companies that are incorporated after 2019. After April 1st, 2019, those companies which are incorporated after April 1st, 2019, government said MAT will not be levied. MAT will not be levied. That exemption government gave. But all other companies, if they are continuously claiming themselves to be zero tax companies, okay, so you will be paying a standard amount of tax on your book profits. So if you are paying MAT, you are not going to pay corporate tax. Okay, MAT is basically because you are claiming exemptions from your corporate tax. You are claiming exemptions from corporate tax. Is this clear, everybody? Okay, so corporate tax is income tax of corporates, but using different methods, companies try to avoid paying tax. This is avoidance only. This is avoidance. You are using all the deductions which government itself has given. So government gives some deductions, they'll use those deductions very efficiently. That is the reason tomorrow if you're a tax officer, IRS officer, your logic is to collect as much as tax possible. But the chartered accountant's logic is to save as much as tax that is possible. So that means a generalist is fighting out with a specialist. As simple as that. No, generalist is fighting out with a specialist basically in this particular criteria. You're a generalist, he's a specialist. As simple as that. So here, these exemptions and deductions are clearly visible and companies try to save their tax. Then a standard amount of tax called MAT is levied on book profit. On individual also later they have brought in such a kind of tax which is called as AMT. Alternate minimum tax. Alternate minimum tax. So AMT is on individuals. Okay, so AMT is alternate minimum tax. Nothing to worry. MAT is on companies basically. MAT is on companies. Is this clear, everybody? Okay. Now, so MAT is direct tax or indirect tax? First thing. Direct tax. First thing is it is direct tax. Okay, and minimum tax paid on book profits. Clear. No, dividend is out of the profit. Okay, so dividend is out of the profit, and there was another tax there, which is called as the dividend distribution tax. Book profit is the profit before deductions and exemptions. Book profit is the profit in the book before deductions and exemptions. So before applying all these deductions and exemptions, whatever profit is visible in the balance sheet, that is the book profit. Okay. Once you apply the deductions, exemptions, etc. Is this clear, everybody? Okay. So one is income tax, then corporate tax, then we have talked about MAT. So MAT is something like a presumptive tax. You use the word presumptive. Presumptive. Presuming that you are making profits. Presuming that you are making profits, the tax is levied at a fixed rate on your book profits. Presuming that you are making profits. So not you are making loss. Obviously there is this 15% because you're presuming that the company is making what? Profits. Okay. Now there are some taxes which were there earlier but which are removed later. These are also direct taxes. For example, one such tax is the fringe benefit tax. I'll make you write after 5 minutes. So fringe benefit tax, these are the taxes paid by the employer. Tax paid by the employer on the fringe benefits he is giving. On the fringe benefits he is giving. Employee is not paying, employer. Let's say I am the company, you are the employees. There are several fringe benefits given to the employees other than the salary. Other than the salary. So on those fringe benefits which the employer is distributing or giving to the employees, the employer has to pay this tax called fringe benefit tax. It was there earlier, this has been removed now. So anything with a cross mark means that tax is not there today. So fringe benefit taxes were there earlier and subsequently removed. Okay, so fringe benefit tax is paid by the employer on the fringe benefits distributed to the employees. Okay, so actually employer will also save tax by distributing these benefits. Are you able to get this? As part of deductions, no, he'll say, okay, fine, your LTC travel or something, okay, flight travel, or maybe your travel expenses. Okay, so all this the employer is giving you other than the salaries. So he will also use that for saving his taxes. So government initially said on the fringe benefits you are giving, you also pay a direct tax. Employer pay this direct tax called fringe benefit tax. Is that clear? Okay. Then there was another tax which was removed in 2020. This tax was there and it was removed in 2020, which is called as the dividend distribution tax. Okay, so this is also a direct tax. Dividend distribution tax. Dividend distribution tax. So companies here, this tax also was paid by the employer or the company which is distributing dividends. Dividends are given to whom? shareholders. As simple as that. Interest is paid to the bondholder. Dividends are given to the shareholders. So when the company is distributing dividends to its shareholders, the company at the source, when it is distributing the dividend, at the source, that means when it is distributing the dividend, this tax has to be deducted and paid to the government. This is called as the dividend distribution tax. Is that clear, everybody? So dividend distribution tax, DDT, dividend distribution tax. Okay, so dividends are distributed to the shareholders. Okay, so you all are the shareholders for a company, and company, whenever it is making profits, from its profits it is going to distribute what? Dividends. So on the dividends distributed by this company, the company has to pay, not the receiver. The company has to pay a tax which is called as dividend distribution tax. Is this clear? It's a direct tax which has been pushed off in 2020. I hope it is clear. Okay. Then there was also one more direct tax which was there but which is not there today. Okay, that is basically called as the wealth tax. So 2015 wealth tax has been removed. Wealth tax has been removed in 2015. Wealth tax has been removed in 2015. So wealth tax is what? Tax on wealth. Okay, and tax on wealth, wealth can be assets, wealth can be cash, wealth can be gold, anything above 30 lakhs. Anything above 30 lakhs, okay, wealth above 30 lakhs, it can be in the form of gold, it can be in the form of cash, whatever it is, anything above 30 lakhs was taxed at a standard rate of 1%. Was taxed at a standard rate of 1% by the government. Now, problem is, it is very difficult to collect the wealth tax. So, Modi ji understood having too many taxes is of no use. Why? Because unnecessarily you have to recruit people for collecting the tax, you have to pay them salaries, etc. Administration costs will increase because you have to implement taxes. Why all that headache? Have high buoyant taxes like GST, which will give you high revenue. And when you have wealth tax collections were so low that there is no point in having a wealth tax only. So your tax should give you revenue. So you're having a tax, then you need administration to collect those taxes, and it is very difficult to certify the wealth of people in India and collect that tax at a rate of 1%, which is above 30 lakhs. So all this is very complicated, and it was not an efficient tax. Not an efficient means government was not getting enough revenue from the tax. So obviously when you're not getting enough revenue, there's no point in having such a tax, so they removed it. So wealth tax was abolished in 2015. Is this clear? Okay, so that is also, so tomorrow he may give which of the following is not a direct tax or an indirect tax. That point of time he may give some taxes which are not in use now. But at least you should know that it is a direct tax. Is that clear? Yes. So dividend distribution tax is there, wealth tax, and then, okay. Now there are taxes. There is one tax called capital gains tax. Which list? Union list or state list? Union list. Okay. Income tax also union list. Corporate tax also union list, isn't it? So this capital gains tax is also a direct tax which is paid on the capital gain. Which is paid on the capital gain. Okay. And this capital gains tax can be levied on physical properties. Physical property. It can also be levied on something like the financial instruments. Financial instruments like shares as well as debt instruments. Shares as well as debt instruments. And this capital gains tax is paid by the seller. Capital gains tax is paid by the seller on the capital gain. Capital gains tax is paid by the seller on the capital gain. Did we talk about this yesterday, right? So this capital gains tax, there were a lot of challenges because companies were trying to avoid capital gains tax. Companies were trying to avoid capital gains tax, and therefore there were a lot of issues with respect to capital gains tax. Again, there are two types of capital gains taxes which we will discuss after we write. One is called as the long-term capital gains tax. Okay, long-term capital gains tax, and another one is short-term capital gains tax. UPSC till now has never asked the question on long-term and short-term, but there is a slight difference between long-term capital gains and short-term capital gains. Is that okay? Most of you are meditating. Most of you today. Today, maximum population, you are meditating. That means you are in deep state, which generally takes for people like Sadhguru and all, no? After 1 hour of meditation. After 1 hour of meditation, they are lost. Okay, either they are full, you are somewhere actually. And every, in the first benches also you are blinking. As if there is some music going on. Or you feel these taxes are very simple and easy maybe. That also may be the reason. You know everything about direct taxes. Of course, out of all the taxing system, GST was the difficult area. All these are all not your level. Yeah. So I didn't put a cross mark. I didn't put a cross mark means it is there. Taxes are not over. There are other taxes also like banking, cash transaction, which was there. Fringe benefit, not there today. Okay, wealth tax, not there. Dividend distribution 2020, they have removed it. See, again in the budgets, they can bring it back. DDT, dividend distribution tax. Okay. TDS is tax deduction at source. It's a TDS concept only. Tax deducted at source. Okay. Put the heading direct tax. Direct tax. On the same wealth? If it includes cash, gold, everything, which is above 30 lakhs, 1%. When your wealth is calculated, whatever wealth is above 30, there will be wealth tax. Yes. First of all, how many of us will show the wealth? Okay, so write down. Write down. It is a direct tax. Write down. It is a tax where the burden of the tax cannot be shifted. The burden of the tax cannot be shifted. It should be paid by the person or entity. It should be paid by the person or entity on whom it is levied. Okay. In brackets, write the impact and incidence of the tax. The impact and incidence of the tax are on the same point. Impact and incidence of the tax are on the same point. Okay. Are there any direct taxes of state? No? I'm just asking. VAT? Your VAT is subsumed into SGST, no? Hey, VAT is subsumed. VAT and sales tax is an indirect tax. प्रॉपर्टी टैक्स. अरे यार आप तो वैट बोल दिए तो फिनिश. वैट इज नॉट अ डायरेक्ट टैक्स. वैट इज एन इनडायरेक्ट टैक्स. नो, व्हाई आर यू ब्रिंगिंग वैट हियर? Tax on land, okay, properties, okay. There is something like professional tax. Professional tax we pay to the state only. So all these are direct taxes. Okay, fine. First write. Understood. Write down. Different types of taxes of the central government are. Different types of direct taxes of central government are. First one, income tax. Income tax. And I think I made you draw that slabs of income tax earlier. Yes, okay, just write down. This is the most common type of tax. This is the most common type of tax. Most common type of tax that an individual pays to the government. That an individual pays to the government. Income tax is progressive in nature. Income tax is progressive in nature. And an additional surcharge is levied. And an additional surcharge is levied on incomes crossing 50 lakhs. On income crossing 50 lakhs. Okay. Next, put the heading corporate tax. It is nothing but income tax of corporates. It is nothing but income tax of corporates. Okay, continue. A company, whether Indian or foreign, a company, whether Indian or foreign, is liable to taxation, is liable to taxation under Income Tax Act. Okay, continue. Presently, base corporate tax is 22%. Presently, base corporate tax is 22%. Okay, so base corporate tax is 22 means on that again cess, surcharges, cesses are applicable. Huh? So base corporate tax is 22%. Continue writing. Several companies try to avoid tax payment, try to avoid tax payment using legal loopholes, in the taxing system, loopholes in the taxing system, and therefore government decided to levy, a minimum percentage of tax, on book profits. On book profits. In bracket, write MAT. MAT. Is that okay? Next, put the heading minimum alternate tax. Minimum alternate tax. Minimum alternate tax. It is a provision in the direct tax laws. It is a provision in the direct tax laws to limit tax exemptions, availed by the company, to limit tax exemptions availed by the company. Full stop and continue. MAT is fundamentally a means to prevent tax avoidance, a means to prevent tax avoidance by making companies pay a minimum tax, by making companies pay a minimum tax at a rate of 15%, at a rate of 15% on their book profits. Is that okay? So, if company is paying MAT means it's not paying corporate tax. Is that okay? Yes. Next, fringe benefit tax. FRING, fringe benefit tax. Fringe benefit tax. Currently, it is not in use. Okay, so just write down. Was applied to every fringe benefit. Was applied to every fringe benefit. Every fringe benefit passed by an employer. Passed by an employer to their employee. To their employee. Full stop and continue. It covered employee welfare. It covered employee welfare, comma, accommodation, comma, entertainment, comma, employee stock option plan, employee stock option, shares and all, stock option plan, stock option plan, etc. Okay, it was started in 2005 and scrapped in 2009. It was started in 2005 and scrapped in 2009. Okay. Then put the heading banking cash transaction tax. Banking cash transaction tax. Not there now, but earlier it was there. Banking cash transaction tax. Okay. So it's a direct tax. It was enforced between 2005 to 9. It was enforced between 2005 to 9. 2005 to 9 at a rate of 0.1%. At a rate of 0.1% on every bank transaction. 0.1% on every bank transaction. Is that okay? Yes. Then put the heading capital gains tax. Capital gains tax. Write down. Any profit or gain, any profit or gain that arises from the sale of capital asset, the sale of capital asset is a capital gain. Sale of capital asset is a capital gain. Capital assets include land, comma, buildings, comma, jewelry, comma, patents, comma, financial instruments, etc. Financial instruments, etc. Okay. Then put the heading short-term capital asset. Short-term capital asset. Short-term capital asset. Write down. An asset which is held for not more than 36 months, not more than 36 months. So it is 3 years. Okay. Now there's a change also. Not more than 36 months is a short-term capital asset. Is a short-term capital asset. Okay. Continue writing. From 2017-18, from 2017-18, the criteria of 36 months, the criteria of 36 months has been reduced to 24 months, has been reduced to 24 months in case of immovable properties, in case of immovable properties like land and buildings, in case of immovable properties like land and building. Okay, that means, so what is the meaning there? That is something like this. See, that means you will be eligible to pay long-term capital gains tax. One is short-term, another one is long-term. Okay. Okay. So one is long-term capital gains tax, another one is short-term. So short-term capital gains tax with respect to land and building, you will be liable to pay short-term capital gains tax on land and building when you are holding the asset for a period of less than 2 years, less than 2 years. That's the meaning. That means if you are holding the asset for more than 2 years, then you are going to pay long-term capital gains tax. If you are holding it for less than 2 years, that means you purchased, suppose I purchased this building for, let's say yesterday's example, 10 crore. And let's say after 15 months, okay, after 15 months I have sold it for, let's say 20 crore. After 15 months. That means I am eligible for paying short-term capital gains tax. But if I am holding it for 25 months, I am holding it for 25 months, I am sold it after 25 months, then I have to pay what? Long-term capital gains tax. Earlier it was 36 months, now it is 24 after 2017-18. That means long-term capital gains tax comes when you are holding the asset like the physical asset for a period of more than 2 years. Again, this will vary for shares. For example, financial instruments, again, there are different types of financial instruments and the tax will be different for different types of financial instruments. So, for example, when I talk about shares long term means if you are holding it for a period of more than 1 year. We are holding it for more than 1 year. If you are holding it for a period of less than 1 year, then it is short term. Are you able to get this? Okay, so fine. I'll give you a break after two minutes. Right now. Long-term capital asset. Today, Josh is missing. That enthusiasm is not there. Huh? So what? So second class for everybody. Okay, so third class today. Very good. Okay, third class. Yes. Okay, right. Long-term capital gains or long-term capital assets. Write down. Write down. Write down. Yes. An asset that is held for more than 36 months is long-term capital asset. Is long-term capital asset. Okay. In bracket, put 24 months for land, comma building. 24 months for land, comma building. Is that okay? Okay. Okay. Tax on, or just mention, long-term capital gains tax is 20%. Write down. Long-term capital gains tax is 20% plus surcharge, plus surcharge and education cess. Education cess. Okay. Cess. Huh. Then write down tax on short-term. Write down tax on short-term capital assets. Tax on short-term capital assets. Tax on short-term capital assets when STT is not applicable. When STT is not applicable. STT. Okay. Tax on short-term capital assets when STT is not applicable. STT is what? Securities transaction tax. Securities transaction tax. So this is also a direct tax. This is on the stock market transactions. When you are doing any stock market transactions, there is a tax which is levied, which is called as STT. Actually, STT started becoming more popular because they started avoiding CGT on shares. CGT, they were tax avoidance with respect to CGT was increasing, and therefore STT started becoming more popular. STT is something like securities transaction tax. Though you are a buyer or a seller, irrespective of buyer or seller, on stock market transactions, on securities, there is some amount of tax that is levied. That is called as securities transaction tax. Similarly, there are commodity exchanges where commodities are transacted. From 2013 onwards, there is this commodities transaction tax. So in the share market, securities are traded. Traded means buying and selling of securities. So when buying and selling of securities is happening, there is some amount of tax which is levied, which is called as securities transaction tax. Similarly, commodities can be traded in the commodity exchanges. Commodities can be traded in the commodity exchanges. There are some commodity exchanges where commodities can be traded. Commodities are traded means financial instruments representing commodities will be traded. For example, gold is not traded. Financial instrument representing gold will be traded. So there are some exchanges like the multi-commodity exchange, which is called as MCX SX, multi-commodity exchange. In this multi-commodity exchange, there will be trading of commodities, buying and selling. So suppose you want to trade with rice also, oil also, wheat, and even commodities like gold, silver. Okay, so financial instruments representing these entities can be traded. Okay, so these are traded in the commodity exchanges, and when they are traded in the commodity exchanges, there is this direct tax which is called as commodity transaction tax. In the share market, when shares or securities are traded, you also have something called as the security transaction tax. Are you able to get this? See here, first of all, two things. One is, we have talked about capital gains tax. So capital gains tax will be paid by the seller on the capital gain which he receives. So on the capital asset which he is selling. So capital asset can be land and building. It can also be it can be gold, okay, physical gold. It can also be something like shares, financial instruments like shares. It can also be debt instruments. Debt instruments, again, criterias are different. So UPSC will not dig deep and ask with respect to debt instruments, what is long-term capital gains? UPSC will never ask such questions, 99%. 99% UPSC will not ask. Till now, UPSC has only asked capital gains tax. They have not even touched long-term and short-term. But the logic of long term and logic of short term is very simple. Long term capital gains tax you will pay when you are holding the asset for a longer period. That is the meaning. You are not holding the asset for a certain period of time. You are selling it off before holding it for a certain period. You will pay something called as short term. Are you able to get this? Now, and this criteria of long term and short term will be different for the physical properties, as well as shares, as well as bonds. It will be different for all the entities. For example, for shares, generally long term is taken for 1 year. That means if you are holding the asset for a period of more than 1 year, so generally there are exemptions of long term capital gains tax. They give when you're doing a share market transaction, if you are paying STT, you're already paying STT and you sold the shares after 1 year. Okay, so STT, since you have paid securities transaction tax, long-term capital gains tax is generally not collected only on the shares. Okay, but shares criteria is for 1 year. These are equity instruments. No, share is equity. So equity related instruments, that long-term, short-term is 1 year. Generally, the basic definition of long-term and short-term was something like 30 to 36 months. So government used to say if you're holding the asset for more than 30 to 36 months, then you will be paying long-term. If you're holding it for less than 36, you will pay short-term. But again, after 2007, in the budgets, they keep changing. In the 2017-18, they said long-term for physical property, we will reduce it to 2 years. That means if you are holding it for a period of more than 2 years, then you will pay long-term. Less than 2 years, short-term. Are able to get this? Okay. But again, debt instruments, it will be again different. 3 years is the criteria, debt instruments. So don't worry about debt instruments now. So tax on short-term capital assets when STT is not applicable. This is what you have mentioned. Write down. What happened? Another 2 minutes. Short-term, write down. Short-term capital gains, write down. Short-term capital gains, same point, write down. Short-term capital gains is added to your income tax, is added to your income tax, added to your income tax, or you can write added to your income tax liability, basically, income tax liability. Okay, and the taxpayer is taxed, and the taxpayer is taxed according to his income tax slab. According to his income tax slab. According to his income tax slab. Slab 3 to 6, that is the slab. So you made a short-term gain by selling some shares. So the amount you have made is added to your income, and they will check in which slab you are falling, and accordingly you will be taxed. That is what is the meaning. Is that clear? Yes. If STT is applicable, then short-term capital gains is taxable at a rate of 15% plus surcharge. 15% plus surcharge. 15% plus surcharge. See, you need not remember these numbers because these keep changing. 15% plus surcharge. What is the meaning? If STT is not applicable, okay, your income will be added to the income tax, and whichever slab you fall, you will pay accordingly. If it is there, then you will be taxed at rate of 15%. 15. Is that okay? Take a break. Okay, write down taxes on wealth and capital. Next, put the heading taxes on wealth and capital. Under that, one, wealth tax. Wealth tax. First introduced in 1967. First introduced in 1967. Wealth tax. 1967. It was levied on excess of net wealth. It was levied on excess of net wealth. Levied on excess of net wealth over 30 lakhs. Over 30 lakhs at a rate of 1%. Okay, continue. Wealth tax has been a minor source of revenue. Wealth tax has been a minor source of revenue. Minor source of revenue. And the tax stands abolished. And the tax stands abolished with effect from 2015. And the tax stands, all right, and the tax is abolished. And the tax is abolished from 2015. Is that okay? Yes. Then put the heading dividend distribution tax. Dividend distribution tax. Dividend distribution tax. Dividend refers to dividend refers to the distribution of profits to shareholders. The distribution of profits to shareholders. Profits to shareholders of a company. Of a company. Thus DDT is a tax. Thus DDT is a tax payable on dividends offered. Payable on dividends offered. Dividends offered to its shareholders by the corporation. Dividends offered to its shareholders by the corporation or the company. Offered to its shareholders by the corporation or company. Continue writing. Higher dividends mean higher taxes on the corporate entity. Higher taxes on the corporate entity. Okay, continue. In budget 2020, DDT was abolished. DDT was abolished. And the incidence of dividend income taxation. And the incidence of dividend income taxation, dividend income taxation is shifted to investor, is shifted to investor from the companies, is shifted to investor from the companies. Okay. So what is the meaning? Dividend distribution tax, the company is distributing dividend. On the dividend it is distributing, it is paying this dividend distribution tax at the source. So now DDT is removed, dividend is distributed. Now the tax will be collected from the investor. Investor means the people who are receiving the dividend. That is the meaning. Okay, so this is basically a concept of donor donee when it comes to gift tax also. Gift. So donor of gift is somebody who is giving the gift, is the donor. Donee is somebody who is receiving the gift. So earlier the gift tax was pushed in and then removed also. And initially gift tax followed a donor concept. Donor means what? Those who are giving the gift. Okay, so generally all those gifts less than 50,000 are not taxable. Gift amount less than 50,000 are not taxable. I'm talking about gift. Okay. And similarly, there are some concessions in the form of inheritance of properties, etc. Generally, parents or siblings, etc., when they are pushing off their property, then when they are transferring their property also, they generally write something called as gift deeds, because there are exemptions under the gift tax. So for siblings, etc., legal heirs, etc., and also marriages, gifts and all are not taxable. Able to get this? Okay. So now this is a concept of donor and donee, same logic here. The word marriage has made him motivating. Okay, gift has made. Okay. So he says dowry. Okay. Donor is somebody who is giving the gift. Donee is somebody who is receiving. So the burden has been shifted from the donor to the donee or the receiver. So here dividend distribution tax also, it is on the entity which is distributing the dividend. For example, company is distributing dividend, on the dividend it is distributing, it is paying the tax. Now this DDT has been removed, then you are receiving the dividend. That dividend which you receive will be part of your income, and subsequently tax will be collected from the investor or the receiver. This is the meaning. Is this clear? Yes. Then write estate duty. Estate duty, not in use now, just write down estate duty. Estate duty. Estate, ESTA. Estate duty, write down. First introduced in 1953. First introduced in 1953. It was levied on total property. Levied on total property, passing on after the death of the person. Total property passing on after the death of the person. The whole property of the deceased person, the whole property of the deceased person, constituted his wealth, constituted his wealth, and liable for tax, and liable for tax. Okay. The tax is abolished. Tax is abolished in 1985. 1985. Okay, fine. So next put heading gift tax. Gift tax. Okay, first point, write down. Gift tax is a provision introduced by Parliament. Gift tax is a provision introduced by Parliament in 1958. 1958. Okay, next point. It was introduced to impose tax. It was introduced to impose tax on giving and receiving gifts, on giving and receiving gifts, giving and receiving gifts, which is specified under the Act, which is specified under the Act. Okay. These gifts can be in any form. These gifts can be in any form, including cash, comma, jewelry, property, comma, shares, comma, vehicles, etc. Okay, is that clear? Next point, write down. Though gift tax is applicable on gifts, though gift tax is applicable on gifts whose value exceeds rupees 50,000, whose value exceeds rupees 50,000, 50,000. The gift is exempted from tax if it was given by a relative. Relative. So that word relative has a wider extension. Okay, so one is parents, spouse, siblings. Okay, so again you have lineal descendants, like that. It is clearly specified. That exemption is there. Okay, so is this clear till there? Okay, next point. Next point, write down. Gifts received as part of inheritance. Gifts received as part of inheritance is exempted from tax. And also gifts received during weddings. And also gifts received during weddings are exempted from tax. Is that okay? Okay. Continue. Cash or rewards received from local authorities. Continue, you can continue. Cash, full stop and continue. Cash or rewards received from local authorities, or educational institutions, on the basis of merit, is also exempted from tax. Okay, fine. Is that clear? Okay, now see here, this is an important area. See, from here, there can be a question in this area. Okay, so listen very carefully. So the word budget is not there in the constitution. In polity class, again, you will read, you have annual financial statement. There is something called as annual financial statement under Article 112 of the Constitution. Okay. And as we have understood earlier, when I talk about budget, you have two things as we have mentioned of the annual financial statement. One is we have used the word incoming money, remember, and outgoing money. Okay. And in this incoming money, we use the word called what? Receipts. Receipts. And in the outgoing money, we have used the word called expenditure. Is that okay? And when we talk about receipts, currently, so earlier there was a lot of confusion. Confusion in the sense there were different types of expenditure. One was something like the developmental expenditure. Okay. Non-developmental, you don't have such classification now. Now, non-developmental expenditure. Okay. Okay, so developmental, non-developmental expenditure. That means something that was leading to creation of assets, something that was not leading to creation of assets. So like this. So the classification was very difficult to understand because, for example, if I say anything that is leading to creation of assets is developmental, and anything that is not leading to creation of assets is non-developmental. Now, can I say defense? Defense. Now, economists may say defense is something like non-developmental. But defense or security is even more important than economics. Are you able to get this? No, defense or security, first of all, you need to be alive for economics. Okay. So, if there is no security, then there is no economics as to. So, defense and such kind of spending which government makes, whether it is the spending on defense expenditure. Now, outrightly, economists cannot say this is not required, this is not a developmental expenditure, it is useless. Because defense comes above economics or security comes above economics. So, the bifurcation becomes very difficult. So, there was several committees that were appointed. Okay. One was the Rangarajan panel, and then Bimal Janal committee, etc. Bimal Jalan committee, Rangarajan committee, they were mainly trying to handle these challenges. Earlier, there was also something like the planned expenditure. This is also not there now. Planned expenditure and non-planned expenditure. Non-planned. I have written developmental, non-developmental. Planned, non-planned. Planned is something that is planned in the 5-year plans. So, non-planned is something that is not planned in the 5-year plans. So, generally planned expenditure is basically long term. So, sudden expenditures are basically non-planned. So, this bifurcation of planned, non-planned is also not there in the budget now. Similarly, you don't have the bifurcation of developmental and non-developmental expenditure because bifurcating subsidies as development is something that is leading to development and that is not leading to development is not correct. One example is something like the defense or security. And therefore, after the recommendations of Bimal Jalan and Rangarajan committee recommendations, they removed this concept of developmental, non-developmental. And they have only come up with a bifurcation where they'll focus on, when I say receipts, there will be only two types of receipts in the budget. One is the revenue receipts. Okay. Another one would be the capital receipts. Is that clear? Okay. And in the expenditure, you will have only two. One is the revenue expenditure and another one would be the capital expenditure. Is that clear? Now, this is the bifurcation which you will find in the budget. We'll see the budget. Of course, next year budget you will remember some facts. I will be showing this year's budget. What were the main important areas? That we will do tomorrow. Now, first you try to understand when I talk about receipts. One is the revenue receipts, and another one is the capital receipts. Okay, so whenever I use the word capital, it has some future implications. Anything related to capital has future implications. It is not settled immediately. It has some future implications. Revenue is something like it is something like settled currently. Okay, and these revenue receipts are basically recurring receipts. Recurring receipts means on a continuous basis. What are the two types of revenue receipts? What are the main two types of revenue receipts? Obviously, one would be the revenue receipts which will be coming from the tax source. Okay, tax. Okay, so this is tax source means tax revenue receipts. Okay, so tax, again the tax can be further bifurcated into the tax will be further bifurcated into direct taxes and indirect taxes, which we have discussed. Here we have excise, now you have GST, and here you have corporate tax, income tax, and all these taxes. Are you able to get this? Then we also have the non-tax revenue receipts. Non-tax revenue receipts. So one is the tax source, another one is the non-tax source. So for the government, tax source is a major source of its revenue receipts. That is the reason tax collection should be efficient for the government. Tax revenue should be more for the government. So that means its direct taxes and indirect taxes should be efficient. Now the question comes up, what are the different non-tax revenue receipts for the government? What are the different non-tax revenue receipts for the government? Anybody? No, wait. Okay, listen. Loans are not revenues. Loans are part of the capital. Always remember. Okay, so loan is always part of the capital account. In the BOP also, we have put loan in the capital. Remember that? Okay, now listen very carefully. One is the government receives something like revenues from the profits of PSUs. PSUs are making profits, that profit is for the government only. So this is incoming. Receipt means what? Always remember, it is incoming money. Money is moving into government's pocket. Okay. Similarly, if government would have given some loan, then government receives what? Interest received. Interest received by the government. This is also incoming money. Everything incoming only has to be pushed here. 3, grants received by the government. Very important, grants received. Only it is not loan. Grant is different from loan. Okay, so remember, grants need not be paid back. Okay, so it can be grants or it can be gifts or transfers. Remember, grant or it can be gifts. Suppose Modi ji has gone abroad, Melinda Gates madam has given some gift. It got stuck. Only that, or is it working? Hyperactive. No problem. Yeah. So there's problem in that there. You just follow from here. Okay. So here, listen. So profits of PSU. RBI transfers. Uh. See, there. Okay. I'll let it be okay then. We'll discuss. Today, some are very happy, and some are lost. Lost means meditation. Completely in deep sleep there. RBI generally, no. There are restrictions in the FRBM Act. We'll talk about it. Okay, so RBI generally gives loans. Now it's okay? Okay. See, RBI transfers, you know about RBI's profits. Okay. So RBI has to transfer its profits. Earlier there were problems also with respect to this issue. So RBI is one of the highest profit making entity. Okay. So earlier RBI's, for example, RBI's revenues are 7 times its expenditure. 7 times its expenditure. RBI's revenues were almost 7 times its expenditure. So earlier RBI used to transfer around 60,000 crores, 70,000 crores to the government. So RBI is government entity only. So RBI profit is government's profit only, no doubt about it. And RBI used to transfer this money in August. RBI used to transfer this money in August every year. It used to give it to the government. But the problem came up like demonetization. So because of demonetization, printing new currency, etc., RBI started incurring some expenditure, no, spending money. So because of that, RBI profits have reduced and RBI started giving 13,000 crore, 12,000 crore. And government was unhappy, number one. Government was saying, what is this you are giving? Okay, so what we thought and what are you giving? Number one. Number two, another problem was, okay, another problem was which most of the RBI governors who are non-bureaucrats were not happy. Okay, current governor is a bureaucrat. So bureaucrat, no problem. But earlier there were governors who were not bureaucrats. So they generally don't gel with the government. They are pure economists. So they will feel like, what is this? Okay, you are asking for money, that's okay. But government was also asking for interim transfer. What is the meaning of interim transfer? In February itself, in the middle, generally they used to give it in the August. So now Feb itself, give me 10,000 crore. Okay, why? Because by March 31st, I want to show that the gap between my receipts and expenditure, which we are writing here, okay, the gap between the receipts and expenditure is less. Suppose you're transferring money to the government in Feb itself. So March 31st, I can show that the deficit is less. Are you able to get my point now? Deficit is less. No, your gap between expenditure and receipts is going to be less because you're getting more R. R should increase. Okay, so different ways of increasing R. Okay, so one is transfers. So some economists say one time if you're taking 10,000 crore, it's okay. Every now and then if you're asking 10,000 crore in Feb only, that is not correct. Check your policy. Now government's logic is see our account, it is empty. See your account, it is full. Okay, so what is your problem to transfer money? This is government's logic. But the logic is government should compare its exchequer or government should compare its accounts with other countries' governments. You cannot compare your accounts with RBI. Are you able to get this? No, RBI. So like this, there were several conflicts which came up earlier with respect to RBI transfers. What is the meaning of transfer? RBI's profits being given to the government. So mainly conflict was not with the profit being transferred. Conflict was also with respect to interim transfers. Interim transfer means in between only. Before March 31st, you are asking for money. So once a while, if you are asking, it's okay. Every time you are saying, give 10,000. Okay, so there was some issue. Okay, till here I think it is clear. So profits of PSU is important for as a non-tax revenue receipts. Okay, gifts, grants. Okay, all these are also part of revenue receipts. Okay, revenue receipts. Anything else? Fines or fees collected, for example, passport fees, etc. Okay, so all this is also incoming money into the government's pocket. Fines and fees collected by the government. Okay, then receipts which government gets from general services. General services. Okay, some receipts means incoming only. Receipts generated from general services. Okay, so receipts from general services means something like receipts which it is getting from, for example, you're applying for a UPSC, etc. There's some fees which you pay. Okay, so public service commission is a general service. Okay, so something like the revenue which it generates from the receipts of general services. Or if the government is also generating some receipts from social services, receipts from social services. If receipts from social services means it is generating some money here. Money should be incoming. Okay, whether it is maybe schools or maybe hospitals, whatever it is. Okay, or it can also generate some receipts from economic services. It can generate some receipts from economic services. So economic services can be transportation, communication, etc. Okay, so from that government is generating some money. Here government is not spending. When I say receipt means you have to generate some money. Money should be moving into government's pocket. So when I am using the word receipt, first thing I have written here is incoming money. That is what we have written. So whatever I am writing here, it should be incoming into government's pocket. It is not spending. So whether it is profits from PSUs or interest or grants, everything is received. Nothing is given. Okay, so whatever is moving into government's pocket, that only can be written here. Is that clear, everybody? Yes? No, 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 no. Wait. So that is basically capital. You're talking about selling of assets, no? So capital, asset. So when I'm talking about selling of assets, etc., everything will be part of capital here. Okay. Till here, have you understood? Okay. Always remember, interest is always part of revenue, though loans are part of capital. Okay. So if you remember the BOP account, BOP is different. Okay, so BOP in the basics class we were talking about. Okay, BOP is an accounting statement maintained by the resident of the country. Okay, where he is recording the transactions with economic transactions with rest of the world. This is what was the definition of BOP. So in that we have put one is the current account, another one is the capital. And where will transfers go in the BOP? Where will transfers go? Current account. Remittances are also transfers. Remittances are also transfer. The meaning of transfer means in return you are not doing anything. Gift is also same. In return you will not do anything. You will just say thank you. Take the gift. Gift or transfer or grant. Everything is free. These are all transfers. Are you able to get this? Okay. So, and also interest is part of revenue, loans are part of capital. Okay. Now listen very carefully. So one is the tax source for the revenue receipts. Okay. Another one is the non-tax. So major chunk is obviously the tax source. So government, if the tax is not good, tax source is not good, then government is going to struggle with respect to its receipts. So non-tax source will be limited. Non-tax source will be limited. Okay, here we have written non-tax revenue receipts. Okay. Now, what are capital receipts? So, since I have used the word receipt, it is going to be incoming money. Okay. So, what are these receipts? This is incoming money, and all those receipts which are going to reduce the assets of the government, all those receipts which are going to reduce the assets of the government or increase the liabilities of the government. All those assets, all those receipts which are going to reduce the assets of the government or increase the liabilities of the government are called as capital receipts. So all receipts which are going to reduce the asset or increase the liability. Okay. Example 1, loans taken. First thing, incoming money. So it is receipt, and loan is part of capital. So it's a capital receipt. Is that clear? Okay. So loans taken means nothing but borrowings made by the government. Okay. So is that clear? Okay. So this is not revenue. It is only a receipt. Okay. So this loans taken by the government will reduce assets or increase liability for the government? It will increase the liability for the government. loans taken will increase the liability for the government. Why? Because that loan has to be returned back by the government with interest. Is that clear? Understood? Okay. Then, second one, disinvestment. Basics class, did we use this word? Okay. So, disinvestments made by the government. Disinvestment means government selling off its assets or shares with the intention of earning revenue. So, government is selling off its assets or government is selling off its shares with the intention of making revenue. That is the reason disinvestment will not fall part of revenue. It is part of capital because government is selling off its assets. It's a capital. Are you able to get this? So, disinvestment will reduce assets or increase liability. Disinvestment will reduce the assets of the government, as simple as that. Disinvestment proceeds. Government is selling off its shares or government is selling off its assets and earning some money or earning some revenue. I hope it is clear, everybody. Okay, so now because of disinvestment, what is happening? Government's assets are decreasing. Everybody is following? Government's assets are decreasing. Suppose there are loans recovered by the government. There's a difference between loans taken and loans recovered. Okay. Loans taken means government is taking new loans. Loans recovered means government has already given loans earlier, which is repaid by the entity. Repaid. They are repaid. So that means government has recovered the previous loans which it has given. But in the present year, it is incoming money. It is moving into government's pocket. So therefore, it is received. And loans are part of capital and therefore they are capital receipts. Are you able to follow? Okay. Now, loans recovered by the government will reduce its assets or increase its liability? Loans recovered will again reduce the assets of the government. See here. Loans recovered will reduce the asset of the government. Is that clear? Why? Because this loan is an asset on which government was receiving regular interest. Are you able to get this? This loan which government gave was an asset. Loans are asset. For example, what is loan for a bank? Asset, because bank was receiving regular interest. Similarly, this loan which is given by the government is an asset for the government on which the government was receiving regular interest. Now, this loan has been recovered means this loan which was earlier an asset, which was giving regular interest, is no more an asset now. It is no more an asset because it has been recovered by the government. So that means this loans recovered will reduce the asset. Something that was an asset earlier on which government was receiving regular interest is no more an asset today, and therefore loans recovered is going to reduce the assets. Is this clear? Okay. So one is, we have written incoming, outgoing. In the incoming, receipts. Okay. And then in the outgoing, it is expenditure or payment. This everybody knows. Suppose I'll ask you one question. Let's see what you will tell. Like, interest-free loans taken by the government. Interest-free loans taken by the government. Where will it go? Very difficult question. Interest-free loan. See, interest-free loan or loan with interest. It is loan only. Don't think too much. Loan has to be paid back. And interest-free loan taken means it is incoming money. First thing, you will divide it into two parts. Taken means incoming money. So first is receipt. Then comes loan. So capital receipt. As simple as that. Okay. Grants given by the central government. Grants given by the central government. Where should it go? Grants. First of all, grants given. Given means incoming or outgoing? So it should be part of expenditure. First thing is that. Then grant is part of revenue. So it is revenue expenditure. No confusion. Like that, break it into two and then think of the solution. Then the answer will be easy. Now, grants given by Indian government to Bangladesh. Grants given by central government to Bangladesh. Bangladesh. So where should it go? Grants given means outgoing. Outgoing money. Grant given is outgoing, so expenditure. Grant is part of revenue, so it should be part of revenue expenditure. Is that clear? Okay. Bonds issued by central government. Bonds issued by central government to raise money. Got the question? Bonds, bonds. Some bonds, G6, G6 are issued, no? Okay, so G6 issued by central government. What is government doing through these G6? Borrowing money. Borrowing money. Through bonds, government is borrowing money. So government is borrowing money means government is taking loan. So it is loan taken. It is nothing but loans taken. So loans taken means first is incoming. Incoming means receipt. Loan part of capital. So it should be capital receipt. So it should be part of capital receipt. So bonds, your government is issuing bonds, RBI is issuing G6 on behalf of government. Okay, but who is borrowing money? Government is borrowing money through bonds. So that is again part of what? Capital receipt. It will fall here. It will fall here. So market loans, okay, whatever loans it is, it can be treasury bills, it can be T-bills, or it can be G6. Okay, you call them as dated security. I'll discuss in the money market. Dated means long term. It can be long term or it can be short term. Whatever it is, if it is loan, it should be visible in capital receipt. It should be clear. Is that okay? Okay. So now this earlier they used to ask one question from here, which one will fall where and things like that. Okay, so it was a very common question they used to ask. Very simple and common question. Okay, now in the expenditure part, there are two divisions here. We have written revenue expenditure and capital expenditure. Of course, we don't have much time, but you have understood now. There should not be any problem. So when I say revenue expenditure, generally revenue expenditures are seen as futile expenditures, useless. According to economists, any expenditure which is not leading to creation of assets, because this expenditure is not leading to creation of assets. Okay, all this expenditure which is not leading to creation of assets is called as revenue expenditure. And this is something like money spent on day-to-day activities. Day-to-day activities. Developing countries like India spend more money here. During COVID pandemic, government ended up spending more money here. Okay, so on day-to-day expenditures, for example, maintenance of law and order. Maintenance of law and order. Okay, so Ganesh festivals and many other festivals, whatever it is. So there is police force involved. Okay, so these are basically seen as revenue expenditures or day-to-day activity, day-to-day. Similarly, payment of salaries and pensions. Payment of salaries and pensions. Okay, so salaries and pensions are also seen as revenue expenditure. So government is coming up with 7th pay commission, 8th pay commission, 9th pay commission, and increasing the salaries means that is going to increase the revenue expenditure of the government. Okay. 3, subsidies given. Subsidies given by the government. Subsidies given. Okay, that is also part of revenue expenditure. Somebody was asking, sir, there was an article in the newspaper about subsidies and incentives. Okay, so there's some article in the newspaper talking about differentiating subsidies and incentives. But subsidies are generally seen as non-developmental, generally. Of course, there are subsidies. The whole logic is subsidies will pull back the country. The economist logic is subsidy will pull back the country. Okay, but of course subsidies are required, and there are different types of subsidies also, but subsidies are generally, it's an headache for the government, because without creating assets, there is spending that is happening from government's pocket. So earlier, government used to follow administered pricing mechanism for petrol and diesel before 2010. What is the meaning of administered pricing mechanism? The prices are fixed by government. Suppose IOCL was pricing petrol at 60 rupees a liter, government was selling it at 45, 42, 43, 45. Okay, so, and that 17 rupees was coming from government's pocket as subsidy. And that point of time, petrol rates were controlled through administered prices. Administered prices means you're not leaving it to market. This administered prices are fixed. It is administered by whom? Government. No, we have time. Okay. Administered prices. See, if we are able to complete in time, otherwise what will happen subsequently afterwards, every class will get extended automatically, unknowingly. Half an hour extra, 40 minutes extra, you'll be struggling, you'll be dying. So better is time to time it is completed and revised. Okay, is that clear? Okay. So now see here, subsidies given. So subsidies given generally are not seen as productive because they are not leading to creation of assets. But subsidies are required for welfare. Subsidies are required. Okay. Then the most dangerous of all revenue expenditures, or the maximum chunk of revenue expenditure, is going for this aspect called as interest payments. The highest amount of, out of all the revenue expenditures, the major chunk of money is going for interest payments. I'll show you the recent budget also. It clearly shows that major chunk of money is going for interest payments. It is dangerous. Why it is not good? It is because if suppose for the previous loans you are making interest payments, suppose sometimes if you know, suppose 3 years back you have taken a credit card and you have to pay bills, you don't have money, so you're taking new credit cards, and you can get some cash if you have connections with the credit card and pay the old interest on the old credit card. That means you're taking new loans for making payments for the previous loans, which is very bad and useless. You're taking new loans to make payments for the previous loans, means slowly you're getting into debt trap. You're slowly getting into debt trap. Okay, and always remember, that is the reason government has to reduce its borrowings. If borrowings are increasing, then subsequently it will also increase the interest payments. Loan is not free. You have to pay for the that means there will be some interest payments which are being paid by the government on the previous loans taken by the previous governments. So previous government would have taken some loan. On that also, if that loan is getting continued, the present government may be making some interest payments. Always remember, these loans or debt can distort intergenerational equity. Did I use this word earlier in the basics class? So loans or borrowings will distort intergenerational equity. Intergenerational equity means, I would have given you this example also earlier, I don't remember. Suppose your great-grandfather said, grandfather, please come, take this 200 crores loan, not money, and enjoy. Now grandfather calls father, he made it 300 debt. Okay, and come on, this is your responsibility. Now father called the son, made it 400, and he has put this weight on the son's head. And then the father says, enjoy, rock on. Now what can you rock now? You see, whatever minimum payment or profit you earn will be getting into interest payment only. You cannot think of investment. Forget about investment. You cannot think of savings only. Your whole life is getting into payment of debt. That means something that was done by great grandfather has distorted intergenerational equity. So if previous governments have taken too much of loan, the present government cannot spend much on infrastructure or whatever is required for the present generation. Are you able to get this? So why? Because maximum chunk of its payments or spending is going in what? Interest payments. Are you able to get this? So too much of borrowings cannot be a solution. Government cannot depend on debt because it will distort intergenerational equity over a period of time. Because, for example, the impact of COVID can be seen in the next 3-4 years. It's not that COVID impact is over. Because of COVID, government would have spent a lot of money by borrowing. By borrowing, if you have spent money, then who is going to make the interest payments? Government has to make the interest payments. So government has to make the interest payments. There are different ways government can do it. So government will decide not to reduce the excise duties on petrol and diesel. Okay, pay. We will collect and pay. So this is a common thing. Government decides, like, let me get maximum revenue possible, as much as possible from the taxes. So the common man is going to get affected because of these excise duties, whatever it is. Okay. Similarly, government hands will be tied with respect to spending money on welfare also. So all these are going to distort intergenerational equity. Till here, is it clear? Okay, I'll just write 2-3 points, that's all, and then we will continue from there. Okay, so one is I've written maintenance of law and order. Then I've written salaries and pensions paid by the government. Everything is outgoing here. Okay. Then grants given, grants or gifts or whatever it is. Okay, given. Or it can also be dividends paid, dividends paid. Here it can be dividends received. Dividends received. Everything goes like incoming and outgoing. Dividends received. Dividends received. Okay. Similarly, expenditure made by the government on the different kinds of services it is rendering. For example, government is spending money on general services. Government is spending money spent on general services, or money spent on social services like health and education. Government is spending money on social services like health and education. Or government is spending money on some economic services, transportation or irrigation, whatever it is. So government is spending money on economic services. Everything is spent here, money is spent. Money is spent. Government is spending money from its pocket. Similarly, postal deficit. Postal deficit. How many of you want to join Indian Postal Service or something? Anybody interested in postal services? No. No, sir, we want only police service. Huh? So why postal deficit means what? When we talk about the post offices, the gap between revenues and expenditure. They are not making revenues, obviously. So usage is very limited now. So gap between revenues and expenditure. So expenditure is there, but revenues are not there. That means there is a deficit. But this deficit is funded from the government's budget. This deficit is pushed from the government's budget. Government is spending money from its pocket for handling postal deficit. Government is spending money from its pocket means incoming or outgoing? Outgoing. And therefore postal deficit have pushed it under revenue expenditure. Are you able to follow? Yes. Okay. So we'll stop here. We'll continue from here tomorrow. That's better. Okay. Done.